Hello, and welcome to my guide to International Financial Reporting Standards, the IFRS, presented by myself, Agnieszka Mazurek. I first wanted to start off with explaining what IFRS is. To build trust among stakeholders, investors, and companies, financial openness and consistency are essential. The International Financial Reporting Standards is a widely accepted financial reporting structure. For individuals who are interested in the ever-changing realm of international finance, this blog provides insights on the history, development, and present state of the IFRS. The history. The International Accounting Standards Committee, or the IASC, was established in 1973. Marking the beginning of international financial reporting standards existence. The IASC was established to develop worldwide accounting standards. The task of creating these standards was taken on by the International Accounting Standards Board, the IASB, which was reformed from the IASC in 2001. To replace SIC 8, the board released IFRS 1 first-time adoption of international financial reporting standards in June 2003. The IFRS 1 was then reorganized by the board in November 2008. By December 2010, the board changed IFRS 1 to reflect that a first-time adopter will restate previous transactions from the date of the transition to IFRS standards rather than on January 1st, 2004. It expanded across borders at this time. This was also when IFRS achieved platinum status worldwide. The SEC stated that it anticipates independent U.S. GAAP to remain in place for the foreseeable future, but it hopes to promote additional efforts to bring the two standards into alignment by 2012. In 2014, the IFRS 9 2009, the IFRS 9 2010, and the IFRS 9 2013 were replaced by the IFRS 9. Since its release in 2003, IFRS 1 has been modified to take into account requirements for first-time adoption brought about by new or updated standards. The IFRS 17, Insurance Contracts, which was established in May 2017, was the most recent amendment to IFRS 1. It added an exception to the retroactive application of IFRS 17 and mandated that first-time adopters apply the transition provisions in IFRS 17 to contracts that fall under its authority. A vast array of standards covering various aspects of financial reporting are included in the International Financial Reporting Standards. These standards are intended to address certain accounting concerns and offer recommendations for the correct and consistent presentation of financial data. I will list all 17 of them as shown in the side. The IFRS 1 is the first-time adoption of international financial reporting standards. IFRS 2, share-based payment. IFRS 3, business combinations. IFRS 4, insurance contracts. IFRS 5, non-current assets held for sale and discontinued operations. IFRS 6, exploration for the evaluation of mineral resources. IFRS 7, financial instruments disclosures. IFRS 8, operating segments. IFRS 9, financial instruments. IFRS 10, consolidated financial statements. IFRS 11, joint arrangements. IFRS 12, disclosure of interests in other entities, IFRS 13, fair value measurement, IFRS 14, regulatory deferral accounts, IFRS 15, revenue from contracts with customers, IFRS 16, leases, and IFRS 17, insurance contracts. We will now look at the 4 guiding principles of international financial reporting standards. They are comparability, relevance, clarity, and reliability. Comparability is needed in order for users to spot patterns and draw insightful comparisons. Financial statements must be comparable over time and between various businesses. Relevance in financial data ought to be relevant to users' requirements, enabling them to validate prior assessments or create projections. Clarity should be clear and concise presentation of the financial accounts, which is essential for users to comprehend the data and make wise decisions. If a rocket scientist can't read it, or worse, your accountant, you have a problem. Reliability should include information that accurately, completely, impartially, and faithfully depicts the entity's financial status. Compared to the generally accepted accounting principles, the GAAP, which are based on rules, IFRS is principle-based and offers greater freedom. Reduced transaction costs, economic efficiency, cross-border investments, and global corporate expansion are some advantages of international financial reporting standards. In economic efficiency, assisting investors in identifying opportunities and dangers, IFRS can improve the capital allocation and reduce expenses for businesses. In the growth of foreign businesses, IFRS can support the expansion of international businesses. This can strengthen the economy. In investments across borders, IFRS encourages uniformity in financial reporting, which can help with the economic integration and cross-border investments. IFRS may result in reduced transaction expenses as well. Adopting and pulling into practice international financial reporting standards presents not only a lot of advantages, but a number of difficulties. The IFRS implementation necessitates substantial instruction and training. This can be costly. It's also possible that there aren't enough qualified experts on hand to apply the IFRS standards. It might also be challenging to stay up to date with the most recent advancements due to the frequent updates to IFRS standards. The fact that IFRS standards are founded on concepts as opposed to regulations, it may cause them to be interpreted differently. Although IFRS standards are intended to offer guidance on intricate financial transactions, putting them into practice can be quite difficult. When implementing IFRS, political pressures may provide difficulties as well as cultural aspects. Additionally, additional study is required to fully understand these difficulties in implementing IFRS in developing nations. Also, time-consuming. Focusing on GAAP. GAAP stands for Generally Accepted Accounting Principles. These are a set of rules that govern accounting in the U.S. Compared to the IFRS, GAAP requires more disclosure and is more prescriptive and thorough. Below, I will list other distinctions between GAAP and IFRS. Asset revaluation is only marketable securities may be revalued under GAAP. A greater variety of assets may be revalued under IFRS. For inventory valuation, in contrast to the IFRS, which permits FIFO and weighted average but not LIFO, GAAP permits all methods of inventory valuation. Investment property, while IFRS distinguishes property maintained for capital appreciation or rental revenue as investment property, GAAP includes all property in the broad category of PP&E. For developmental costs, whereas IFRS capitalized and amortized these expenditures over a number of periods, GAAP views them as expenses. Write-downs. While IFRS permits the write-down to be reversed, GAAP stipulates that the write-down amount of an asset cannot be reversed if its market value increases. For the majority of publicly traded corporations, more than 140 nations mandate or allow the use of international financial reporting standards. Countries like Australia, Canada, the European Union, and other significant financial markets are mandatory or required. Permitted countries include numerous additional nations, but nations such as Singapore, Russia, Malaysia, Pakistan, the Philippines, Brazil, Chile, India, Israel, South Africa, South Korea, and Taiwan. The current state of the IFRS. Currently, as of 2024, IFRS is still being developed to satisfy the needs of a constantly shifting financial environment. The United States has not fully yet adopted IFRS and continues to use its own accounting standards, the GAAP. In order to improve the transparency and comparability of financial information for investors, the International Accounting Standards Board, the IASB, recently released new standards such as the IFRS 18, Presentation and Disclosure in Financial Statements. This will go into effect in 2027. Currently, the International Accounting Standards Board and the International Sustainability Standards Board are both of the IFRS Foundation because of the significant impact that the adoption of the IFRS has had on ESG reporting and disclosures. ESG reporting, as in the environment, social, and governance reporting. Companies can show their dedication to ethical business practices and satisfy stakeholders' growing demands for transparency by coordinating financial reporting with sustainability objectives and ESG measurements. By incorporating these ESG factors into IFRS reporting systems, businesses can better convey their efforts to address social and environmental issues while simultaneously improving the quality and applicability of financial data. Currently, globally, the ability of IFRS to lower organizations' capital expenses is another significant benefit. Investors perceive less risk when financial statements are clear and similar. This results in less expensive access to finance. According to research, businesses who use IFRS save money when compared to those that continue to use local accounting standards. A decrease in capital expenses makes it easier for businesses to raise capital. This enables them to make investments in expansion, which spurs innovation to the mutual advantage of all. For better use of resources, IFRS is crucial in assisting investors to make efficient use of their resources. Reliable and comparable data helps them make better investment decisions, as stated previously. This makes the global financial sector more integrated and encourages cross-border investments. Additionally, IFRS promotes prudent capital expenditure by ensuring that funds are allocated to companies with strong growth prospects. IFRS enhances resource use and fortifies the global economy in general by bridging the information gap. The adoption of the IFRS has been spearheaded by the European Union. all publicly traded companies have been required by the European Union to adopt it for their consolidated reports since 2005. Although it differs by nation, the adoption of IFRS has been consistent throughout Asia Pacific. The accounting laws of Australia and New Zealand are completely in line with it, allowing businesses to state with confidence that their reports adhere to the IFRS standards. China also has its own version of IFRS. It modifies while adhering to more general guidelines. As for Africa, more than 30 countries have either accepted or permitted the use of IFRS. Nonetheless, issues such as shortage of qualified accountants and need for additional training materials persist. Despite these problems, usage continues to increase due to emerging market expectations for accurate reporting. It is being used globally. Now, one might question, why learn about IFRS? Well, knowing IFRS is essential whether you work in finance, invest, or are just interested in the world economy. Some of the biggest corporations in the world base their financial statements on its tenets, which also influence economic policies and investment choices. Proficiency in IFRS can provide professionals with access to global opportunities. Businesses, credibility, and access to international capital markets are improved when they align with the IFRS. Additionally, understanding the IFRS standards helps investors make well-informed decisions in a world that is becoming more interconnected by the day. Plus, let's be honest, it's always nice to sound smart at a dinner party. Since the beginning, IFRS has evolved from a specialized project to a fundamental component of international financial reporting. IFRS is positioned to play a crucial role in establishing transparent and accountable financial processes as the globe struggles with new issues. Continue to learn about how your professional and personal journey may be enhanced by an awareness of international financial reporting standards. And who knows, it's possible that you will find it enjoyable. Thank you.